Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, the hidden cost of buying a home and the CEO of the world's largest miner on the opportunity in Canada, plus a look ahead to the big issues facing us in 2026. That's all ahead. First, for the week that was in business, it's time for the briefs. The pace of inflation was unchanged in Canada in November, rising 2.2%, but prices for food grew at the fastest pace in almost 2 years, up 4.7%. Coffee and beef are two of the main culprits. Meanwhile, housing costs are also elevated, up 4.7% on a yearly basis. While some categories did see relief, including declines in the prices of some services like travel, it's cold comfort to Canadians who are struggling with affordability.
If you're a family that's already having difficulty putting food on the table, the fact that food price inflation might come down, that's not the same thing as food prices coming down.
The housing market slowed in November with volume of sales down almost 11%, according to the Canadian Real Estate Association. The average sale price dropped 2% from the year before to $682,219. That indicates some sellers may be dropping their prices to close deals. A strong signal from the Bank of Canada that it will hold rates where they are for the time being could act as incentive to buyers and sellers to move now rather than hoping for a change of rates. There were 173,000 properties for sale across Canada at the end of November, which was up 8.5% from the year prior, but still 2.5% before the long-term average for November. The federal government is committing almost $100 million to 4 quantum computing firms in Canada as part of a commitment in the budget to support the sector. The first phase of the Canadian Quantum Champion program is aimed at providing funding to a space that Canada has an early lead in. Quantum computing is still very much in its infancy. The federal government officially approved the merger of Canada's tech resources with the much larger British Anglo American. The combined entity passes the net benefit test, according to the feds. It will be headquartered in Vancouver and has reportedly made commitments to create 4,000 jobs and invest $4.5 billion in Canada. Ford says it will take a $19.5 billion write-down as it kills plans for several electric models, including the fully electric F-150 pickup truck. Ford says it will pivot into gas and hybrid models. EV sales in the U.S. fell more than 40% in November after a consumer tax credit there ended. But even as its overall U.S. sales fell slightly, Ford said sales of hybrid vehicles rose 13% in November, and that in a weak market for electric vehicles, Ford's high-end models priced between $57,000 and $88,000 U.S. were not selling. Cannabis firm Canopy Growth plans to acquire Montreal's MTL Cannabis in a deal valued at $125 million. Separately, cannabis stocks got renewed attention on news that U.S. President Trump is moving to reclassify marijuana as a Schedule III drug. That could bring a flood of new investment into the market there. And those are your business briefs. We talk a lot about housing affordability in Canada. Here's a look at the cost of development charges by the numbers. According to housing regulator CMHC, development charges on new builds are costly but vary wildly, from $39,600 for a 2-bedroom apartment in Ottawa to $121,500 in Markham, Ontario. That represents charges per unit of 8% and 15.7% respectively relative to the price of the condo, and they add up. The average new apartment building in Markham was 246 units. That's an added cost of $29.9 million in development charges alone. The highest charges are in the city of Toronto at $130,000 per unit. The lowest were in Quebec, with Montreal's development fees sitting at about $8,500. Similar charges are levied on single-family homes, representing 8.5% of the price of a Toronto home and 9.4% of the price of a home in Pickering. How the funds are used also varies wildly, but the intention is for housing-related infrastructure, things like road and transit, water and sewage, parks, and school land acquisition. In Toronto, about 50% of the total fees collected are used for roads and public transit, but in Langley, BC, that number's closer to 25%. Meanwhile, Langley spends 45% of its fees on water and sewage, which Toronto dedicates only 10% to. Most of the time, development charges are a combination of regional and municipal government charges, and different municipalities have different responsibilities when it comes to infrastructure. CMHC's conclusion that municipal finance and housing finance are deeply intertwined and that more attention needs to be given to how growth is being funded. Coming up, the CEO of the world's largest mining company on why Canada is a place to invest. Stay with us. Welcome back. The world's largest mining company has its largest project in Saskatchewan, the Jansen Potash Mine, but it's also feeling bullish about Canada in general. I spoke to Mike Henry, the CEO of BHP, and started by asking him about the progress of Jansen.
The single biggest investment ever for BHP right there in Saskatchewan. I believe it's the single biggest investment for Saskatchewan as well. It's a new business line for BHP in potash. We are executing 2 stages of what will ultimately be a 4-stage potash mine. The first couple of stages, and we'll see first production in 2027, we'll see BHP producing about 10% of world potash supply. And it's a business we're really excited about. Shareholders are going to benefit from this for decades to come.
I also asked Henry what he thinks about new threats from Donald Trump to put a tariff on Canadian potash.
We continue to watch the situation very closely, of course. Right now, potash is exempted as a USMCA compliant product from tariffs. 80 to 90% of U.S. farmers' potash supply comes from Canada. We think that Canadian potash and the entry of BHP into potash is going to make that even more competitive for U.S. farmers and will be good for both the agricultural community in the U.S. as well as the U.S. economy. But we will watch it closely, of course.
As CEO of a globally diversified player, I asked Henry for his thoughts on what is definitely a new tone on trade around the world.
So this is the new reality. We've gone from decades of fairly benign trade circumstances, open and free trade, to where countries now are seeking to, of course, re-onshore some production capacity. And also in the case of our business, governments around the world are focused on critical mineral supply chain security. So it creates a new level of uncertainty and complexity for us. But BHP, the business model that we have, the commodities that we're in, the fact that we're in the best of the best assets makes us resilient in the face of uncertainty. I'm, as a CEO, trying to make sure that I'm out there engaging with stakeholders to enrich my perspective on the world around us, to better inform our strategy and some of these really big multi-billion-dollar investment decisions that we take.
One place BHP is feeling those changes is with iron ore controls in China. I asked Henry for an update on that.
They call these negotiations for a reason. You get 2 parties showing up at the table with different views initially on what a mutually acceptable outcome is. And then through the process of engagement, we land on what I'm sure will be an acceptable resolution here. China's BHP's biggest market. We have really strong relationships with both Chinese customers, but also Chinese suppliers. And so we continue to work our way through that. In the meantime, we continue to produce at full capacity and ship our product to market.
Like Canada's relationship with the U.S., Australia has a similar relationship with China when it comes to one dominant customer. I asked BHP's Henry if he's also thinking about diversifying.
The reality in our sector is that you ship to where the demand for commodities is. And in the case of iron ore, China is by far and away the biggest consumer of iron ore. The Chinese steel industry has been running at very strong levels, over 1 billion tons of steel production now for 6 years running. So that's going to remain the prime market for our iron ore business. But as we develop more copper, so BHP's big growth businesses are copper and potash, and both of those businesses will have more diversified markets than is the case for iron ore. But in the meantime, or even on an ongoing basis, we intend to continue to focus on the strong relationships that we have in China and continue to do business there. It's been a wonderful market and partner for BHP for decades now, and I foresee that continuing into the future.
BHP is focused on the Canadian market. What role will the metals of the future play in Henry's plans here?
So, look, I'm bullish on Canada. The first big investment that we're making, at least in recent years, is in potash in Saskatchewan. The Saskatchewan provincial government has been very constructive, really welcoming of investment, has gone the extra mile to make sure that investment happens. Now, at the federal level, of course, we've got a Carney government that has pivoted on critical minerals and resources investment more broadly, which I think is going to make it easier to invest, will make Canada an even more attractive place to invest in our sector. From a BHP perspective, we're interested in more investment in potash. I mentioned earlier that we're in the first 2 stages of what will ultimately be a 4-stage project at Jansen in Saskatchewan, but we're also looking for copper, and we've got copper exploration and partnerships underway right across Canada, both coasts and up in the north. And I'm hopeful that in future you'll see BHP investing in both potash and copper.
Recently, BHP officially walked away from its big play for Anglo American. I asked Henry if there's another chapter to that story.
Look, that was an opportunity that we saw. BHP has great growth prospects already in copper. We've grown by 30% in the past 3 years. We're the largest copper producer in the world, and we have 4 big growth projects within our current portfolio. But we're BHP, the largest mining company by market capitalization in the world. We've got the ability to both invest in projects organically and to pursue opportunities to acquire new high-quality copper assets when we can do so and create value for BHP shareholders. In this case, it wasn't to be, so that's in the rearview mirror. But we continue to focus on growing our copper business in the first instance through these big 4 projects that we've got within the portfolio.
The tone in Canada around resource projects has shifted. I asked Henry if that changes his investment thesis here.
We have been focused on investing in Canada for a number of years now, and we took this big investment decision on potash back in 2021, in fact. However, the recent moves by the Carney government to make resources investment easier, quicker, more attractive for international capital are very welcome. I think there's probably still further to go in terms of addressing some of the underlying permitting constraints. But it all bodes well for further investment. It's something that we're excited about. Like I said, we're exploring for copper as well right across the country. And I'm hopeful that in 5 years' time, 10 years' time, there will be further investments that we can make into Canadian resources and specifically into copper.
As CEO of a major global firm, I asked Henry what he sees as the big story of 2026.
Look, I talk to many fellow CEOs right across a range of industries, and I know that some of them are hoping that in the new year there will be fewer surprises, less volatility, more certainty. That's not what we're expecting. We expect that we're in a new normal now. The world is a more uncertain place. Companies have to be able to navigate that uncertainty. We continue to see the economic outlook as being relatively positive, certainly for the sectors that impact on metals and minerals demand. From a BHP perspective, our commodity prices have remained relatively strong. Demand for our underlying commodities has remained strong, and we continue to progress our strategy, which is running a very reliable underlying business and investing in growth. We'll continue to progress the Jansen project in Canada, as well as our copper growth projects around the world.
All right, we need to leave it there. Thanks for being with us today.
Thank you, Amanda.
Mike Henry is the CEO of BHP. Coming up, some of the biggest stories of the year and what we're watching next year. That's still ahead. But first, it seems WestJet is pausing its plan to reduce the legroom on some of its planes, leaving about half of the seats the way they were with normal space and the ability to recline, while others sport the new shrunken cavity that has become the source of much passenger complaint. WestJet has made the changes to about half of the intended planes and says it will revisit the redesign after the busy winter travel season, presumably because winter travelers take up even more space than those in summer wear. The idea was to charge less for the smaller seat. Was that a good plan? We figure where you stand on it depends on where you sit. We're back after this. Welcome back. Well, with a turbulent year wrapping up and a volatile one likely ahead, time for a Taking Stock Roundtable. Sean Spear is editor-at-large at The Hub. Armin Januzan is Atkinson Fellow on the Future of Workers. Thanks to you both for being with us.
Thank you for having us. With you.
All right, I'm going to start with, and I'll start with you, Armin, and then Sean, jump in. I was going to ask what's the big story of 2025, and then I decided I was also going to answer it for you, and that is a trade war. But I wanted to ask, in the context of this huge upheaval we've seen related to Liberation Day and the change in our trade relationship with the U.S., what you think is the most important aspect of that this past year. Armin, you kick it off.
First of all, this sense of betrayal by the people that used to be our closest neighbors, and the idea that no deal is possible in the future because you just don't know what's going to happen next. Secondarily, the growing focus on trying to invite more investment into the country, obviously because we might face a huge wave of disinvestment, but a maybe an overwrought level of openness to investment from any source with no guardrails on it, and less focus, I think, on the human aspect of what some of these things could mean, both in terms of the number of jobs that are available, but also the impact on things like care.
So interesting. And
I agree completely. I would just frame it slightly differently. In some ways, I think the biggest development of 2025 is not just the Trump tariffs and provocations. It's in a way, our reaction to it, particularly under the leadership of Mark Carney, might be characterized, Amanda, as a kind of return of economic orthodoxy. The previous 10 years under Justin Trudeau's government, there was a greater focus on issues of equity and redistribution, and I would argue kind of subordination of orthodox thinking when it comes to markets and investment and all the rest. And I think it's fair to say the way the Carney government has reacted has been a kind of return to basics, as Armin says, a focus on investment attraction, a focus on trying to boost investment and economic growth, and probably at the expense of some of the issues that Prime Minister Trudeau championed in his time in office.
And maybe some other issues. I mean, I want to dig in a little bit to what Armin said, because I thought what I was going to say, Sean, is I think you'll probably agree that sort of shift in tone attracting investment is one of the big changes. That it comes with new costs, I think, is worth discussing for a second. And Armin, let's just talk about what you're talking about when we say, because we're in this weird world. Our government wants to attract up to $1 trillion of private investment by setting the stage with industrial policy. This is not your grandfather's economics textbook. So it's a very interesting kind of market, a belief in the market system and capitalism married to nationalistic policy from government. It's a weird marrying to my mind.
Super weird. I agree with you. I think this is not getting back to basics. I think it's oversteering to make up for the things that markets say they want. And now our markets are, at risk. But the bigger story also of 2025 and moving into 2026, both in the United States and Canada, has been affordability, right? People have been out of their minds with the cost of things because, yes, wages have improved, but they haven't kept up with the cost of the basics like housing and groceries. Basically, the most basic things you can imagine. Yeah. Well, I've been really struck by the fact that within CPI in Canada, one of the fastest growing and consistently fast growing aspects of care, aspects of affordability has been the cost of out-of-pocket purchases of health services, specifically eye and dental care, but also we all know there's not enough care involved through the publicly subsidized system, and we're spending more on it. So, we might be getting more fiscal restraint on public spending, but we're spending more as a society on care. So that, to me, is going to be it's not the insurance problem of the United States, but it is an affordability and cost problem, and it's accelerating because even though Carney has led off with his good foot, which is the investment portfolio, and he's dealing with an economic crisis, he's skipping over the care crisis that in survey after survey, Canadians say is their second most important concern.
Sean?
Yeah, great point. Just 2 points, if I may. First of all, to Armin's point, I think a sleeper issue of 2025 is just as the parliamentary session ended, the Alberta government passed its reform bill, which involves essentially the creation of two-tier healthcare in Alberta. So watch for that in 2026. It's a big development. I suspect provincial policymakers across the country will be following to see the outcomes from this experiment in Alberta. But just secondarily, to Armin's point about affordability, I think that's what makes the Carney government so interesting and why I said earlier that it is a kind of return to orthodoxy. Its budget was focused solely on the macroeconomy, yes, with less focus on the microeconomy. And it seems to me the Prime Minister is making a bet that more investment, more economic activity will ultimately come to address those microeconomic concerns. It's a big bet from a political point of view, but from an economic point of view, it is going back to, I think, the way that governments thought about the relationship between the macro and the micro for the better part of the past 30 or 40 years.
Okay, we've only got about 30 seconds each for what you're watching in 2026. Is it still trade? Is it still affordability, Armin?
Holy moly, three things that I'm watching for. Number one is private equity in healthcare, and I'm going to be talking a lot about that in the coming year. Number two is the AI bubble and whether that's going to collapse and what that's going to mean in global systems. And number three is, can we get any kind of trade certainty, and will we ever make up for the lost investments that are bound to come down the road?
Yeah, three good ones. Sean?
Yeah. Same, especially as the Republican Party heads into midterm elections. Will the Trump administration be more inclined to win-win types of trade outcomes, or are we going to continue to see protectionism out of Washington, which of course is bad for investment, bad for output, and ultimately bad for Canada's economy?
So good to have you both for this. Appreciate your thoughts. Sean Speer, Armin Yalnizyan, thanks to you both.
Thanks for inviting us.
Armin Yalnizyan is Atkinson Fellow on the Future of Work. Sean Speer, Editor-at-Large at The Hub. Time for the takeaway and getting exactly what you ask for. The affordability of housing, or lack thereof, is one of the biggest social problems in Canada. It's why young people feel gloomier than previous generations. It's why the wealth transfer from baby boomers to their kids, which is happening while those boomers are still alive, will continue disparities in wealth across generations. And for all the solutions being offered to housing affordability, few make as little sense as inviting foreign capital into our market. The idea may be tempting. If the problem is a lack of supply, then building more homes solves it. And if our homegrown developers say they can't afford to do that, why not look around at some deep-pocketed investors globally and let them own our homes? The most obvious answer to that is houses are unaffordable because we've made them so through a series of decisions around financializing them. That is, once we started treating housing and the housing market, including the market for financial products that support it, as investments, we lost sight of the goal. If the goal is to have homes for Canadians that they can afford, the two policies are not compatible, and if we ever imagined they might be, we have ample evidence that treating the housing market like an investment has not produced the results we want. It's important to recognize that it has produced wealth for the lucky folks who got on this escalator early enough and already own a home, or who simply have enough money that they can afford to play in this market. But houses aren't like fine art or even the stock market. They have a social value, and we have a shared interest in making sure there are enough of them. So while markets reward scarcity, we need abundance here. Foreign investors would be even further divorced from the social aspect of our housing market. If buying an asset and letting it sit empty was the best way to increase value, that would be the right thing for an investor to do. But let's agree, not the answer we're seeking. And remember, it's already hard to reverse course on the financialization of housing because so many Canadians have a vested interest in it staying the way it is. My takeaway? If financializing housing got us into this mess, more financializing isn't likely to get us out of it. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.